let's talk about some tax gotchas, okay? A lot of tax gotchas, unfortunately, but it is what it is. So we're gonna talk through these here. So Medicare IRMAA. So IRMAA stands for Income Related Monthly Adjustment Amount, and these are surcharges that are additional charges that some higher income individuals must pay for their Medicare Part B and Part D premiums. These surcharges are based on your income and intended to ensure that higher income beneficiaries contribute more towards the cost of their Medicare coverage, okay? So I call it a tax. It's just a tax. You can call it a fee or charge, whatever. It's an additional tax at the end of the day. So if you're not sure how Medicare works, Part B covers outpatient services like doctor visits, lab tests, and medical supplies. Most people pay a standard premium for Part B, but if your income exceeds a certain threshold, then you're going to be subject to the IRMAA surcharges. Part D provides prescription drug coverage through private insurance plans. So like Part B, most people pay a standard monthly premium for Part D, but like I said before, if you have higher income, it's the same income level for both, you may have to face a IRMAA surcharge. All right, so let's talk about how these surcharges work here. The income thresholds for IRMAA surcharges are based on your modified adjusted gross income, okay? Important. It's not your AGI, it's your MAGI, from the 2 years prior. So for example, if your IRMAA surcharge in 2023 would be based on your MAGI from 2021. The income brackets and surcharges are adjusted each year for inflation. So keep in mind though, you can file a form. If you just retired, for example, and maybe prior to retirement, your income was above these Medicare limits I'm going to show you. If you go into retirement, if you get a notice that you're going to be impacted by this, then you want to go ahead and file a form to do that. And if you Google that, I believe it's SSA 44, don't quote me on that, but I think that's what it is. But if you just Google it, it will come up and you'll be able to find that, okay? So here are the income levels. That if you are a single filer and your income is below $97,000, no charges, and below $194,000 for joint filers, no charges. But once you go above that, for single filers between 97 and 123, you're gonna pay an additional $65.90 for Part B, an additional $12.20, so it works about to $800 to $900 per year. And this is monthly, by the way, these charges. And similar here, you go through these income levels. So one thing I want to talk about in a second is called the widow penalty. And what can happen is many people are below these numbers while they're filing joint taxes and married together. But later in retirement, if somebody were to pass away early, one of the spouses, and you have a big RMD or big pensions, it becomes very easy to go over these amounts. And not only are you gonna have to pay additional taxes because you're in now the single filer tax rates, well, you're additionally gonna have to pay potentially IRMAA surcharges, which can be just another, it's kind of just like another jab in the side. It really is what it is. So it's unfortunate, but it's just what it is. But these can be planned for, and that's why we're here today talking about this. So it's essential to be aware of the potential impact of IRMAA surcharges on your retirement planning, as they can significantly increase your healthcare costs. This could be $4,000 or $5,000 a year potentially. So strategies like Roth conversions, QCDs, managing withdrawals from tax-deferred accounts can all help you manage your income strategies and potentially reduce your exposure to IRMAA surcharges. However, it's a good idea, and you can see I mention this over and over. It's always a good idea to consult with your advisor or tax professional to help you work a plan or create a plan that's going to work for you, okay? All right, let's talk about NIIT, Net Investment Income Tax. So the net investment income tax is an additional tax that applies to certain higher income individuals, estates, and trusts. It was introduced in 2013 as part of the ACA to help fund Medicare and other healthcare programs, and it's a 3.8% tax on the lesser of your net investment income or the amount by which your MAGI exceeds specific income thresholds, okay? Here's a breakdown how it works. If your income is above $200,000 as single or head of household, or $250 married filing joint, or $125 married filing separately, then you could be potentially facing an additional 3.8% on the income above that. So this includes various types of income, such as interest, dividends, capital gains, rental and royalty income, and income from passive business activities. It does not include wages, Social Security benefits, or distributions from qualified retirement plans like 401ks and IRAs. But the calculation to determine it, the amount that you owe, well, you'll first calculate your net investment income and the amounts by which your MAGI exceeds the income threshold for your filing status. Then you'll pay the 3.8% tax on the lesser of these two amounts, okay? So here's an example. If you're single with an MAGI of $220,000 and have $30,000 in net investment income, your NIT would be 3.8% of the lesser amount of $20,000, which is the amount by which your MAGI exceeds a $200,000 threshold. and not the full $30,000 of the net investment income. In this case, it'd be $760. So to minimize the impact of this, it's essential to manage your investment income and MAGI carefully. Tax-efficient investing, tax loss harvesting, managing the timing of your investment income can help reduce the exposure. And as always, good idea to speak to an advisor. So the widow's penalty refers to the potential increase in federal income tax liability that a surviving spouse may face after the death of their partner. This increase in taxes can occur due to a combination of factors, including a change in filing status, the loss of certain deductions and exemptions, and changes in income sources. So here's like the main reasons why the widow penalty can occur. Generally, a change in filing status. So when a spouse passes away, the surviving spouse's tax filing status changes from married filing joint to single or head of household in the following year. So the tax brackets for single filers are generally narrower than for those of married couples filing jointly, which can result in a higher tax rate on the same income. So for example, if a couple's combined income is $100,000 and they file jointly after the standard deduction, they'll fall in the 12% bracket. But if you have $100,000 and you're filing in the single filer tax bracket, you're going to jump to the 22% bracket. So that's 10% more in taxes on the amount of money above the threshold, which is about $45,000 or so. Again, something to really think about. And the other thing is you might lose deductions and exemptions. So when a spouse passes away, the surviving spouse loses their ability to claim personal exemptions and may experience a reduction in the standard deduction or itemized deductions they can claim. So your standard deduction might go from $27,000 down to $13,500. That's a huge, deal when it comes to how much income you can qualify for in your 0% tax bracket or pay no tax on. So this can result in an increase in taxable income, which may lead to higher tax liability. And so the changes also in income sources could be a potential thing you want to think about too. So the surviving spouse may experience changes in income sources such as receiving Social Security survivor benefits or income from life insurance proceeds or annuities. So some of these income sources may be subject to income tax, which could contribute to a higher tax liability. All right, to minimize the impact of the widow penalty, it's crucial for both spouses to engage in proactive tax planning. Some strategies to consider include diversifying your income sources in retirement, such as a combination of taxable, tax-deferred, and tax-free accounts, converting traditional IRAs to Roth IRAs during lower income years, which can help reduce future minimum distributions and manage income, reviewing life insurance policies and annuity contracts, ensure they provide appropriate coverage and income replacement for their surviving spouse. And, I recommend that to me, it's essential to work with a financial planner or tax professional to develop a comprehensive plan that addresses the potential widow's penalty and ensures the financial well-being of, both spouses. Okay. I think that's really, really important.